everybody. It's a great pleasure to be here and to be part of the welcome to you all to this Economic Ideas Forum. As you know, it's a very big event, and you've got a splendid agenda tomorrow, and I'm sure it's going to be an excellent day. It's so big an event that, as you probably noticed, President Obama arranged to be in town for it. So, and we've seen him today. And of course, you know, we've all had, as you heard earlier, a little bit of disruption about the as a result of the ash cloud. Not too much disruption this time, but a bit of disruption. And you can't help getting a sense of déjà vu about this, that as Oscar Wilde might have said, one volcanic eruption is unfortunate, two smacks of carelessness. And I can't help observing that, you know, if you think about these, I can't remember any of these eruptions and these damaging ash clouds before the global financial crisis. So I think the gods of Iceland are somehow getting their revenge on us all for this. So if we decide here in Britain and maybe in the Netherlands not to claim our money back for the failure of Landsbanki, I don't think we'll get any more ash clouds. But at the very least, I think we can expect, and I expect the government to take action on this, that if there are going to be any more of these events, that at least we arrange that the names of the volcanoes are pronounceable in future. Anyway, let me just try to set the economic scene for your discussions tomorrow and for your interesting agenda tomorrow. And this, of course, has been a great time to be writing about the economy, even if it's not always been a great time to be living through recent events. When I look back even 3 to 4 years, I sense then that people were not as captivated by economic events and economics as they might have been, as I might have hoped. The only economics people were interested in was the wacky kind of economics, the freakonomics kind of economics, and you know, that is not just jealousy for a best-selling book. People thought that the big economic problems have been solved. We're in a world of low inflation, steady growth, no return to boom and bust, as a couple of politicians here used to say quite often. And things are a little bit different now. I mean, I think now everybody has a view on the economy. Everybody has something to be angry about, often with good reason. And people know that the repercussions of the crisis will live with us for quite a long time. And I think everybody got a sense of the drama that we went through, are still going through as a result of the financial crisis. Now, just to recap briefly, as you will know, the global financial crisis started nearly 4 years ago in the summer of 2007, and that was when we moved from the easy credit-driven growth of the 1990s and the 2000s into something that was very different. That's when funding markets froze, making it very difficult for the banks to fund their lending. Now, initially it was thought that this was just a liquidity crisis, and that if the authorities, the central banks, could just pump in enough liquidity to get the markets through for a few months, maybe a couple of years, everything would be fine. Everything, of course, was not fine. We had the initial big drama here in the UK of the run on Northern Rock, the first run on a UK bank since the 1860s, and then a year or so later, in the autumn of 2008, just 2.5 years ago, we knew exactly how bad it was. The crisis faced by the banks was one not of liquidity, but of solvency. Many of the banks didn't have enough capital to survive, so at that point in the autumn of 2008, the Western banking system came very close to complete collapse. This was a time when, at a practical level, the cash machines nearly didn't get refilled, the supermarket shelves nearly didn't get restocked, the wages almost didn't get paid. It was a time where we were very close to a full state of economic emergency. And you can see that by the exceptional actions that were taken at that time. Exceptional actions in terms of the authorities, in terms of reducing interest rates to record low levels, in terms of supporting the banks directly, in some cases taking those banks into public ownership. How did it happen? Now, when I embarked on my book on the crisis, which is called The Age of Instability, I'm tempted at this point to say it's available in all good bookshops, but I've struggled to find it in any bookshop. So, if you are in a bookshop, ask for it quite loudly, and you can be guaranteed it won't be there, but at least they'll get the idea that it's in demand. And I thought when I embarked on that, the crisis was the product of relatively recent developments. So, you remember the famous ninja mortgages, mortgages in America for people with no job, no income, and no assets. All that subprime lending, which was sliced, diced, and packaged into securities that were really junk, but were rated AAA. And by the way, I thought that the ninja mortgage was always a somewhat pejorative term, and it was used by people who were somewhat superior to describe the kind of mortgages that those who lived in trailer parks in America were forced to take out. But far from it. Ninja mortgages were patented by one particular American mortgage company. You can still, to this day, get a ninja mortgage if you've got no income, no job, and no assets. I don't think there are as many of them as there were, but they're still around. But I think that whole subprime thing, obviously that was the trigger for the crisis. But had it just been that, even though that the losses on those subprime securities were spread throughout the financial system, I don't think the crisis would have been as bad as it was. So I think it was the product of a much longer development, a very long-running credit boom that went back perhaps decades. Now, the so-called shadow banking system in America, which as its name suggests operates outside the public eye and away from the gaze of regulators, dates back to around about 1980. And by the time of the crisis, by the time of the crisis 3 or 4 years ago, the shadow banking system in America was as big as the actual formal banking system. Some people say, of course, that we shouldn't be too hard on the banks. After all, they were simply providing the needs of businesses, the needs of us as consumers. Businesses wanted to invest, so they needed credit. We wanted to spend or buy houses, so we needed credit or mortgages. There is some truth in that, and there's no doubt that the majority of people benefited from that easy availability of credit. But the interesting thing to me is that the biggest increase in credit during this period was in the financial sector itself. So if you look, for example, at the UK, and the UK is not untypical, 2/3 of the rise in private sector debt from the early 1990s to the eve of the crisis was financial sector debt. The financial sector is supposed to lend to industry, to lend to individuals. Mostly the financial sector lent to itself, and that, I think, was a bad thing. It also, of course, generated huge returns for the people who worked in it in the process, and that can't be allowed to happen again. It's the regulatory challenge, and I know you've got a session on that tomorrow, to prevent that happening again, to prevent this excessive lending within the financial system rather than out from the financial system. Why didn't more people spot these dangers as they were arising? The Queen went to the London School of Economics in November 2008 and asked her famous question: if these things were so large, why did nobody see them coming? As always, a very good question. Certainly none of us gave enough thought to what was happening in the banking system. We assumed that banks and their boards knew what they were doing. We assumed that regulators would not allow them to do anything so risky and irresponsible as they did. We regarded them, if we regarded them at all, if we thought about the banks at all, we regarded them as like financial utilities, a tap of credit to be turned on where it was needed. Even those whose job it was to spot what was going on in the banks, to spot the problems, such as the bank's own auditors and the specialist banking analysts, mainly failed to spot anything wrong too. It's also the case, I think, that nobody could ever really have got this crisis right. It's easy with hindsight to think that it was always going to pan out in the way that it did. But on the contrary, I see it as a whole series of crossroads, at each of which we could have gone in a different direction. There was no guarantee it would unwind in the way that it did. And the biggest crossroads of all, of course, was in September 2008 and the failure to rescue Lehman Brothers. Now, it is quite possible that the global banking system would still have come close to collapse and the world economy fall off a cliff as it did then, in the absence of the failure of Lehman Brothers. But it's also, I think, quite possible that things would have turned out differently and the outcome would have been much less damaging than it was. In some senses then, I think the crisis was, to answer the Queen, literally unpredictable. But it happened, and so where did it leave us? We have, of course, got two big hangovers, the fiscal hangover and the banking hangover. But what we've also got is a pretty impressive global economic recovery. And one of the interesting things to me is how quickly the global economy has bounced back. In 2009 saw the first year in the post-war period when world GDP actually fell. Previous world recessions had seen a slowdown in growth, often to negligible growth, but never a fall in world GDP from one year to the next. That happened in 2009, largely in the space of 6 or 9 months, which started in the autumn of 2008 and lasted until the middle of 2009. World trade fell by 12% in 2009, compared with just 1 or 2% in previous post-war global recessions. As I say, pretty well all of that happened in the falling off a cliff moment from October 2008 until May, June 2009. Since which time we've had an astonishingly good global recovery. So in 2010 we saw growth of around about 5% for the global economy, similar to the rates of growth we were seeing before the crisis. World trade has almost made up the ground it lost in 2009 and rose by about 13% in 2010. The great danger that we would see a descent into protectionism in this crisis did not transpire. The world trade is back. It's back up to pre-crisis levels and is growing quite rapidly. So that is extremely good news. Now, emerging economies, of course, led by China, but also including India, Brazil, perhaps Russia, Indonesia, Vietnam, Nigeria, many countries in Africa, which is welcome, are much less affected by the aftermath of the crisis. Their banking systems are much less damaged, their public finances much less in trouble, and don't require the kind of substantial surgery that we're seeing closer to home. Asian economies, having had their rehearsal for the global financial crisis with their own Asian financial crisis in 97, 98, made themselves more resilient, less vulnerable to the whims of markets. That means while parts of the world are indeed hobbled by the after effects of the crisis, others aren't. And I think we should be very positive about this. Growth, wherever in the world it is occurring, creates opportunities, and we're seeing those opportunities now. And I'm very much of the view that the re-emergence of China, India and the rest will be of benefit. It's a sustained positive economic shock for the world. And I say re-emergence advisedly because you only have to go back a couple of hundred years to a time when China and India between them accounted for between 50 and 60% of the global economy. So we're re-emerging, not quite there to that state we had 200 years ago, but the re-emergence of China and India is, I think, very good news. So we should celebrate that. We should celebrate the fact there is a good global recovery, and that even in Europe, most economies are recovering, in some cases very strongly. But I think we should also be more than a little embarrassed about the fact that one of the big risks to the global recovery is the problems in the Eurozone. Looked at from other parts of the world, the Eurozone's difficulties are seen as a key risk. The risk that people see is that the fiscal crisis in the Eurozone feeds back onto the banking system and gives us another dangerous leg of the global financial crisis. And already, of course, we've had 3 rescues in the space of just over 12 months, Greece, Ireland and Portugal, and additional help for Greece, or a rescheduling of Greek debt, is being negotiated as we speak. In some ways, I see the Eurozone crisis as an aftershock of the global financial crisis. In some cases directly, in some countries directly, in some cases indirectly, the crisis produced large budget deficits and big increases in government debt. It happened in Britain, it happened in America. The difference within the Eurozone was that problems in one member country were seen to have a contaminating effect on the others. This meant that Greece could not be seen in the same light as, say, Argentina in the early 2000s and follow the normal debt restructuring route and the devaluation route. That remains the problem that is yet to be resolved. Now, of course, markets get lots of things wrong. I mean, markets are not as efficient as people thought they would be, but markets are markets, and they can be very ruthless, extremely ruthless. They can also, I would accept, be wrong. I think, however, if the problems for Greece, Ireland and Portugal were purely temporary, the markets would probably accept that. The difficulty, I think, is that markets recognise that the problems problems go much deeper. Now, I don't want to go into the old arguments I wrote about 10 years ago in Will Europe Work about whether the Eurozone could ever be an optimal currency area. That's for maybe another occasion. I think it's more a question of how countries behaved once they were members of the Euro. The problem to me is the lack of convergence in economic performance. After being initially sceptical, I'm genuinely impressed by what was achieved under the Agenda 2010 reforms in Germany. Important changes were made and unit labour costs were held down. Germany was hit hard by the global recession in 2008, but its bounce back has been very impressive. There is much to admire about Germany, and Germany is not alone, other European countries as well. But in the case of Germany, the exporting performance and so on, as I say, GDP is almost back to pre-crisis levels, something that won't happen for at least 2 years in Britain. But Germany's success has made life more difficult, I think, for other countries. The problem economies in the Eurozone have, of course, big budget deficits and big debts and rising debts, but they've also lost competitiveness, between 20 and 30% on the unit labour cost measure since the euro came into existence a decade ago. That's a problem, and not only do these economies have to undergo a period of intense fiscal austerity, very painful fiscal austerity, but they also have to get back that lost competitiveness against the moving target that is Germany. I think that's tough, and I'm not sure which way that is going to go, whether the populations of these countries, the electorates of these countries will have the stomach for that very difficult fight. So I think there is work to be done, a lot of work to be done within Europe. There's much to be grateful for in the way the world has come out of the crisis and the global economic recovery. The current situation is immeasurably better than the situation we faced just 2.5 years ago. But things are a lot better than we had a reasonable chance, a reasonable probability of them being. But as I say, there are problems there, and it's unfortunate that some of those problems reside in Europe. There's a long way to go before we can be sure that Europe is through this crisis, and I think there is, I say, an enormous amount of sacrifice, an enormous amount of work before we'll be able to conclude that Europe is truly through the difficulties we've had over the last 2, 3, 4 years. Thank you very much indeed.